Hello, everyone. Welcome back to the Midnight Markets podcast. My name is Sofia Cruz, your host, and here we break down trending financial topics with insights from the sharpest minds in the industry. This week, we have a really renowned professor in the business school, Professor Arthur Wilson. Thanks for being with us today.
Thank you for having me, and I look forward to the conversation.
I'm so excited to have you here this week. Could you introduce yourself a little bit more to our audience?
Okay. I am an economist by training. In fact, I went to the University of Chicago undergrad and then went there for graduate school. I like the place. And from there, I found myself studying stock options markets, which, although economists have written extensively about stock options, in fact, it's considered a finance topic. So when I went and sought a job as a newly minted PhD economist, they said, "Oh, you're going to be in the finance department." To which I said, "Okay." And I've been a finance person ever since. My interest back then was in stock options. I was fascinated by a curious phenomenon. If you look at the reading of that time, the people writing about stock options, they were predicted to be a minor adjunct to the financial markets of that time. And yet, as soon as they became tradable, publicly tradable, in 1973, within about 2 years, the Chicago Board Options Exchange was the second largest exchange in the world by volume. Now, that's no longer true, but clearly it was not a minor adjunct to the financial markets. And so I was fascinated what caused the experts to be surprised by that phenomenon. And I think part of the answer is that options gave the possibility of arbitrage. That is, you could make certain trades with options and stocks, or with options separate from stocks, that would mimic many of the characteristics of the stocks at lower cost, or would allow you to make trades that you simply cannot do with the stocks. And so options opened up a whole new bunch of possibilities.
Whoa, yeah.
And a lot of investors took advantage of that.
So you've been in the trading floor since the beginning, we could say.
Well, I wasn't on the trading floor. In fact, I as a graduate student, as what happens to many graduate students, at some point I ran out of money. And so I went down to the financial district of Chicago, LaSalle Street. LaSalle Street is the Chicago version of Wall Street.
Uh-huh.
And I started knocking on doors with my resume. And of course, this was a very long time ago, so the internet did not exist yet.
No LinkedIn, no anything.
No LinkedIn, no internet, none of that stuff. So I was knocking on doors and saying, "Hi, my name's Arthur Wilson. I would like to get a job here. What do you got?" And as it happened, the last door I knocked on was the door for the Chicago Board of Trade Economic Analysis Unit. So that turned out to be a really wonderful situation, because on the one hand, they wanted part-timers because I was still a graduate student. And on the other hand, the Economic Analysis Unit of the Chicago Board of Trade did something that's very unusual for almost any entity. They invent markets. Okay? Other economists study markets, and we like to understand markets, and that's great. But the Chicago Board of Trade, they're looking to invent new futures markets. And they did invent some new futures markets. At that time, I was working on the crude oil futures market. So eventually that got developed, and 2 exchanges offered a crude oil futures market. And it's a great success. My part in it was pretty small. Basically, I was the research assistant, and so my boss told me, "Okay, your job is to go over to the Standard Oil of Indiana library, wade through it, and ultimately to know everything there is to know about oil," which obviously I never succeeded at that, but it's a great job paying a bookworm to read things.
Reading is always so important, and especially you've told me that you've done history too.
Yes. When I came to GW, initially I went to University of Connecticut. From there I went to Case Western Reserve, and then I came here. And when I came here, I was told, you're going to teach intermediate finance, which I've been doing ever since. One of the things that struck me about intermediate finance, though, is that it's a hard class to teach. Part of the problem is that the standard textbook puts people to sleep.
Uh-huh.
Okay. And I've tried other textbooks, but so far they all put me to sleep. A second problem is that most finance students, when you say, why do you want to be a finance student, they will say, because I want to control large sums of money. Okay, they want to be a master of the universe. So if you say, oh, gee, you could take this course and you get to be a corporate treasurer and ask for money from the folks that have all of the money, that does not excite. They would much rather be the ones with the money than the ones asking for the money. So they gravitate toward investments. Investments classes are always exciting and always interesting. Corporate finance, intermediate finance, they're disappointed. They're disappointed before they even get there. So it's a tough class to teach. And I realized that I needed to make the class more interesting, somehow find a way. So I tried a couple of things. One thing, I said, okay, students need a context, because what happens if you let them, they will just memorize lots of equations.
Equations, yeah, it's math.
There are lots of equations, and they will memorize them without figuring out where they came from. They just memorize the equations, and that doesn't work, because within 6 months you will have forgotten all of the equations, and you got nothing to show for it. If you understand where the equations came from, that's of value, okay, and you can retain that. So I thought, okay, how do I get students to take this material and put it in their head in a way where it'll stay? And I thought, they need a context. So one thing I tried was, the first 2 weeks I would talk about the history of finance. My hope was that if you understand that stock markets did not exist 1,000 years ago, that somebody had to invent them, then you might say, oh, okay, so if I'm thinking about stock, I have to recognize that the things that you do with the stock market, other people could have done differently with very different kinds of markets. Or maybe not at all. If you go back far enough, there was no such thing that looks even slightly like a stock market.
Definitely.
And so my hope was that by giving students a financial context of the history, that it would be easier to remember the facts and how they fit into the story. That worked for about 20% of the students. The other 80% said, oh, that's history, as in they just didn't want to know the history. Well, ultimately that gave rise to the financial history course that I teach, because it clearly did something useful for some students. Another thing I do that I tried with this class, ultimately it also gave rise to its own course. I came across some software. Students get a virtual company to run. And what's neat about that is that if you get a virtual company to run and you start making financial decisions, if you make bad decisions, the company does not do well, it falls apart. At which point students would then ask me, what did I do wrong?
What did I do wrong?
And that is a wonderful teaching device, and I've been using it ever since.
Yeah.
The challenge with both of those changes is that they involve too much extra stuff to the basic intermediate finance course. So instead, I now have 3 separate courses.
3 separate courses.
But they're fun courses.
But it's interesting because, especially history, because they say that if we don't study history, we might as well just repeat it.
Yeah.
Right?
Yeah.
And especially when we're talking about finance, we've seen so many things that actually repeat over time. And one of them is tariffs. I know that a lot of people even get triggered by the war tariffs nowadays, because that's what's currently shaping the markets.
Yes.
And we cannot avoid to talk about it. And you've been since the very beginning with stocks. I wanted to get your take on tariffs. Is there a specific example through history that we are seeing repeating again?
If I could digress a tiny bit, okay. One of the things that I think illustrates the history repeating business When the Great Recession hit, and we have financial calamity in multiple ways, and there are lots and lots of dissertations that have been written on that, so I'm not going to say much. But many of the commentators said, "Oh, we've never seen anything like that before." Well, that's because they never took a history class.
Period.
It has been seen before. Something similar happened in 1907. Something sort of similar happened in 1763 in Amsterdam. That is to say, that kind of financial calamity, driven by cascading defaults, this is not the first time. And commentators should have known that, but they didn't. Many of the commentators said, "Oh, we've never seen that before." We have.
We have.
Yes.
What have we learned from it?
Well, if you go to my class, no. I think one of the things is that in the Great Recession, as well as in 1907, as well as in Amsterdam, the important thing was to have adequate reserves. In each case, market participants functioned with thin reserves because their feeling was that they could count on somebody else having the reserves in a pinch. Well, if everybody's counting on somebody else having reserves, in aggregate, there are not enough reserves. And so in Amsterdam in 1763, prices started dropping, and all of a sudden mortgage banking houses started going bankrupt left and right, and it was a big mess. In 1907, something similar happened with trust banks.
Trust banks.
And in 2007, 8, and 9, something similar happened with the rest of the financial system.
Yeah.
So these things happen. They are a consequence, in part, of inadequate reserves and in part of inadequate or non-existing regulation.
Yeah.
So,
And that is so. When you said that these events have happened before, it even shows in many different charts that we look at. Talking about 10-year U.S. Treasury yields, they are rising, and that only happened in 2008 last time. That is definitely showing a trend, although it's hard to understand what trend it's showing.
well, okay, to get at that, put that in context. The U.S. economy has been the dominant economy since World War I. Initially, the regulators in the U.S. at the Fed didn't fully recognize that that implied a role. Okay, prior to that time, prior to World War I, London was the center of the world financial market, and that meant the British Central Bank had a very careful role to make sure that financial crises did not get out of control. That role, once Britain had to pay for their share of World War I, they couldn't afford to do that. Ideally, the Fed might have realized, hey, it falls to you to take on that role. They didn't seem to realize that either. And so during the period between World War I and World War II, no one was really in charge of the world financial system. And so when the Great Depression hits, country after country goes off of the gold standard, and they have a real hard time getting back on the gold standard. Ultimately, by the end of World War II, the gold standard is essentially kaput. But you're going to ask about tariffs. So let me talk about tariffs. In the very early history of the United States, it started out under Alexander Hamilton with tariffs. Okay, the federal government at that time was almost entirely financed by tariff income. The Constitution gave the power to collect and levy tariffs to the federal government. The states gave that power up, and I have to assume Alexander Hamilton must have been a really persuasive fellow. But the states gave that up. The federal government had that power, and they used that to pay down the costs of the American Revolution, which was an extraordinary development because, if you were to go back in your time machine and say, I want to buy American debt in, say, 1785, The Articles of Confederation are in place. The Constitution is still on somebody's drawing board. That debt would sell for maybe 10 cents on the dollar because there was real doubt as to whether or not it would ever get paid.
Paid back. Oh.
Right. Within 10 years, when Alexander Hamilton is George Washington's Treasury Secretary, he sets it up so that the tariff revenue is applied to paying down these bonds, and in fact, they restructure the debt, which, this is an early example of restructuring.
Restructuring.
Okay.
Yeah.
They restructure the debt, and by just a few years after Alexander Hamilton did this, U.S. debt is looking like what we would now call investment-grade debt. Before, it was the junkiest of junk. Then it became investment-grade debt because the tariff revenue was dedicated to paying down that debt, and it was sufficient over time to do the job. So tariffs were important. And for much of the early 19th century, the 1800s, they remained important. The federal government had relatively minor role in the economy, like 1 or 2% of GDP or something like that, until the Civil War. And when the Civil War hit, the federal government had to raise taxes. That included an income tax, which gave rise to riots in New York City. But they had an income tax for the war, and then after the war, they kind of got rid of the income tax. But then they reintroduced it around the time of World War I. Okay?
Okay.
So, once, you're in World War I particularly, it was a huge war. The American role into it was huge.
Yeah, it was huge.
You can't pay for that with tariff revenue. So they had to have an income tax and a corporate income tax, and they raised money, and the federal government was able to function with that.
Yeah.
After World War II, the realization was that the chaos of the interwar period should not be allowed to continue, that countries had to work together to facilitate international trade, to facilitate sensible economic development, and that gave rise to a series of negotiations that gradually reduced tariffs down to a relatively low level. I can't give you line and verse on that one, but the general agreement on tariffs and trade reduced tariffs through a series of negotiations well into the 1960s and 70s.
Okay.
And so tariffs then became minor.
Yeah.
A few countries had tariffs that were important to them, and in a few cases, tariffs were important for, say, national security purposes. But for general purposes, U.S. tariffs were minor, and it was in the U.S. interest to do that because that allowed Europe and Japan and other developed countries to recover from World War II. And as they became both developed and, with U.S. assistance, democratic countries, they could basically withstand the threat from, say, the Soviet Union or China, and they were, they all prospered.
Yeah.
We all prospered, including the U.S. But one of the complications was that the U.S. federal government tended to spend more money than they took in taxes.
Oh.
So what does that mean? Well, they have to sell bonds, and increasingly a lot of bonds. I think the last time the federal government ran a surplus was under Bill Clinton for a couple of years. But that surplus is
that's
long
a long
gone.
time ago.
Long gone.
Yeah.
And so as the U.S. government is selling, is importing more than it exports, and it's also spending more in government spending than it takes in taxes, that has to be financed.
It has to be financed.
And the result is that somebody has to buy a lot of treasury bonds. Now, the difficulty with this is that Americans' saving patterns are, on the one hand, relatively low, and on the other hand, relatively stable. And you might imagine that people would, if interest rates went up, people would save more. because that's what we teach. We teach something like that in microeconomics, that people respond to prices.
Yeah.
But the trouble with savings is that it depends on the purpose. If you are saving for retirement, interest rates have a small and, if anything, perverse effect. That is to say, if you raise interest rates sharply and I'm saving for retirement, that means I have to save less, which does not accomplish what you're trying to do.
Yeah.
Okay?
No.
But in fact, when I decide to save for retirement, I have a great deal of uncertainty about how much I will need. And so I figure out how much can I save, and I save that. And I don't even pay attention to interest rates. And I think most folks who are setting aside money for retirement, it's not conditional on the current state of interest rates. They're in the stock market. They're hoping stock market goes up, but the interest rate doesn't have that big an effect on American saving behavior. It does affect investment behavior, but not savings that much. And so you've got a little bit of a challenge with the question of who buys these bonds that the federal government is issuing. And what has happened since, say, the 1960s is that increasingly, just as the U.S. is running trade deficits, that is, we import more than we export, we are also running budget deficits. That is, we borrow more than we collect in tax. We spend more than we collect in taxes, so we have to borrow the difference. And effectively, to a large extent, not perfectly, to a large extent, when we say you buy $1 billion in imports and you sell $500 million in exports, $500 million ends up overseas in somebody's pocket. What do they do with that? Well, they don't really want to spend dollars in Germany, right? They want Deutschmarks in Germany. So what do they do with that? Well, it would be very easy to say, okay, let's buy some treasury bonds.
In the U.S.
Yeah, because they're dollar denominated, and at the time the U.S. was perceived as, profoundly safe country. And so many of the dollars came back in the form of investments in the U.S. economy. And that makes sense because they're the ones accumulating excess dollars. Savers are saving, they're maxed out on how much they can save almost always anyway. And so you've got this relationship, which actually makes sense when you think about the accounting. That is, if you look at the economy in terms of what people spend money on, they spend money on consumer goods. Some of it is set aside as savings. They pay taxes. They buy imports.
Yeah.
On the other hand, if you ask where did their income come from, it comes from somebody else spending money on consumer goods, spending on investment goods, spending on government services, and spending on exports. And I think I'm phrasing that rather clumsily, but the bottom line coming out of that is that the trade deficit, if you want to shrink it, you have to do something about either the budget deficit or the savings versus investment deficit, or both. And that gives rise to a puzzle, because the current administration is trying very hard to shrink the trade deficit without corresponding efforts to shrink the budget deficit or to induce more savings or less investment. Now, we don't want less investment, okay?
That's bad for the economy.
We could hypothetically induce more saving, but that in the short run, that might induce a recession too. And so it's not clear how that could possibly work. So we'll see.
It's a puzzle.
Yeah.
Yeah, and it's so it's so nice to understand it, even as an equation, even how a thing could bring an equilibrium to the economy if we put a mindset to it, if we apply policies to it, and we try to fix it. But it's so interesting how we need to think about it in that way, because these headlines don't even have historical backgrounds. People are saying, oh, this is happening for the first time ever, and it's actually not happening for the first time ever.
No.
And having even that perspective coming from us, from you especially, it's so important. important for, our audience in the business school, specifically for our students, to know this. That when they're talking with anyone else, they don't get, tricked into believing that there's something wrong with some other force that we cannot control. And it's, this happened before.
Well, also, I mean, just the whole notion that somehow countries are taking advantage of the U.S. because they have a trade surplus. Well, that trade surplus is equal and opposite. Not exactly so, but it is, it is intimately related with our having a budget deficit.
Yep.
So much so that one can imagine if the U.S. were to suddenly decide, hey, we're going to get rid of our budget deficit, we're going to raise enough in taxes, or we're going to cut spending enough so that we're not borrowing new money, I suspect we would probably see the trade deficit shrink as well. So you can argue about which is the direction of causality, what's causing what, but given the categories, something's got to give, and so.
Thank you so much for sharing your knowledge with us today, really. And thank you for taking time to spend with us today.
Well, thank you for asking lots of good questions and giving me a chance to talk about my favorite topic.
Oh, we love history and finance, so there's such a good mixture. And thank you so much for being with us today. And for our audience, thank you so much for being with us till right now. And if you like this type of content, please make sure you share with your friends, you drop a comment, you share it with everyone in your school so everyone knows what's currently going on in the markets. And huge shout out to Katie, Josh, and Tanish for making this episode possible. Thank you.
Thank you.
The Midnight Markets podcast by the GWU Stock and Portfolio Management Club features student discussions on finance and market trends. This content is informational only, not professional advice.